Hi everyone, Jeff Yastine here. Make sure to subscribe to our YouTube channel and to find me on Facebook and Twitter. And better yet, share this video with your friends and colleagues on social media. So let's talk about Apple. Great company, great stock to own, and a great stock to trade. But it's also a great example of how investors' enthusiasm for a stock that was ice cold not long ago is now very, very hot. And recognizing that cycle of fear and greed and having at least some sense of whether a stock is undervalued or overvalued as it moves through this cycle is a big first step towards buying low and selling high on a sustainable basis instead of just flying blind and buying whatever the crowd is talking about on CNBC. Reason I say all this, back on January 4th, 2019, so 19 months ago, I was interviewed by Cheddar TV, and they asked me my opinion of Apple stock, which at the time had fallen 40% in the prior 3 months. And I said that the stock was cheap, you should buy it. And since then, the shares are up more than 250%. And you can see the general sense of the conversation with the headline on the screen, Apple's rotten core, ? Now, no one would ever write that on screen right now, but that's what a lot of investors were thinking in those very earliest days of 2019. And that's what we all think at our worst moments when a stock that we like, that we're invested in, is losing money and down 40%. In fact, on the day I was interviewed, Apple stock had just posted its sharpest one-day decline in 6 years. So you can imagine shareholders' fear. But I said buy the stock. And why? Well, as I noted on the air that day, Apple's business was doing just fine. Based on the price of the stock, divided by its expected profits for the year, Apple shares are trading at a price-earnings ratio of 11. Now, if you're new to the stock market, a good shorthand way to remember and think about these things is that a PE ratio, a PE, price-earnings ratio of 11, means investors expect Apple's profits to grow at 11% a year based on the stock price. Now, that's more or less in line with Apple's long-term earnings growth, but that does not include Apple's nice dividend, and it certainly does not include any premium for owning a stock with a huge, loyal following of buyers and a great platform that they come back to and buy again and again, generating huge sums of cash for the company. I mean, I remember thinking about it at the time that Apple with a PE of 11 was basically priced as if people expected that no one would ever buy another iPhone, iWatch, or iPad ever again, or at least buy very few of them. Now, there's more to analyzing a stock than that, but right there, comparing a company's historic earnings growth against its PE value and its ability to generate cash and dividends and all that, tells you when a stock deserves a closer look. The other thing is sentiment. We're talking how investors feel, broadly speaking, about a stock. Now, it's all very subjective. But as I noted earlier, when someone puts Apple's rotten core on their graphic screen, they're just saying what a lot of investors are thinking at the time. And at that time, Apple had few friends in the stock market. So let's compare now with then. As I noted in my TV interview, at the time, the shares were trading at $37 and it was trading at a very cheap price-earnings ratio of 11. Now here we are 19 months later, the stock is trading at $131, but it's priced at a very rich price-earnings ratio of 37. In other words, buying Apple shares now, people are so enthusiastic that they're happy to pay almost 4 times Apple's annual earnings growth rate in order to own the stock. So here's my take on Apple stock now. I would not be a buyer. If you have huge gains on the shares, this is a great point to sell or lighten up. If you intend on owning it long term, that's fine too, but just do a gut check with yourself. Ask yourself if the shares fell 30% or 40% or more, which happens every handful of years with this stock or pretty much any stock. What would that mean to your overall portfolio? Reason I say that is because the last thing you want is to tell yourself that you're a long-term investor now, but later, when the stock is down from its current all-time price, it's no longer a favorite on CNBC, and everyone is wondering if there's something wrong with the company when in fact the shares just got overvalued. You could well lose confidence and sell at a much lower price alongside everyone else. And as you can see here, I mean, this has been quite a run for the shares. And really the point that I am trying to make here is better seen in a longer term chart like this one. Again, tremendous run. If you've bought anywhere in the last, let's say the first 5 or 6 years of the past decade, you're doing very, very well as the stock has gone parabolic. But again, it's easy to forget that stocks do retracements and they fall into their own, sort of secular bear markets from time to time, just in keeping with the cycles of, whatever particular industry and sector that the company is in. Apple is not immune to that. Just want to point it out at a point like this, where the stock is at, 130 or so. But look back to 2012, September 2012, and the stock went on to go to a decline. If you look down here at the bottom left, decline of around 33% or so. Another rally up through 2015. The stock went to another decline of around 25%. Then we get up to October of 2018 after a large rally. And again, that's the point right here in January of 2019, right about here or so, January 4th, the stock was down, ultimately down almost 40%. And, again, it had few friends on Wall Street and had a lot of folks wondering, gee, is something wrong with the stock? When in fact, it just got overvalued and it had to come back down in order to sort of regain some value and bring new buyers in. Now, of course, we're back to, here's February, when just before the pandemic, the stock hit another all-time high. And what do we have here? About a 30% decline. And then finally, we have this huge parabolic move, right? So this goes to the point that I'm talking about regarding stocks going from undervalued to fairly valued to overvalued, and then eventually it moves back down again. And just very briefly, I'll bring up a cautionary tale here about how at times, and we can never really predict these things fully, but at times stocks get so overvalued that they stay sort of on a downtrend for a number of years before they're able to recover, even when they have great businesses. And a good example of this is Microsoft. So this is a look at Microsoft shares in the 1990s. And as you can tell, the stock went on an incredible run. But right here, right in the $50 range for the shares at that time, the stock was very heavily overvalued. I won't go into the numbers and all that, but just based on the profits that Microsoft was earning, and it was earning considerable profits then, just like it is now. But the stock had gotten way, way ahead of itself. Then for a variety of other reasons, the shares began to decline. Government antitrust regulations were kicking in. The company had lost an antitrust case. And you can see here, it took basically about 7 years from the high all the way down to the low, which is basically at the bottom of the 2008, 2009 financial crisis. The shares ultimately from high to low were down about 70% in basically 9 years or so, 8 years. So that's one of those unknowns that everybody has to face, but especially when you own a stock that has this great franchise that you just can't imagine why that franchise would not continue to sustain the stock price for many, many quarters to come. And that's something that we all have to think about when we own these kinds of stocks. So as we take one last look here for Apple stock with this amazing, parabolic run that it's had, and just have to be prepared for what might happen on the other side. And that is how it happens with this stock and every other stock in the market. Stocks like Apple go from undervalued to fully valued, then overvalued, and occasionally extremely overvalued. And noting when and where that's happening will help you maintain better control over your own financial destiny and help lead you to sustainable success in the stock market. I'm Jeff Yasteen.